Namibia's economic indicators pointing to a relatively low slowdown during the first quarter of this year, that due to an overhang effect resulting from strong growth which came through last year. Now the slowdown implies that analysts can expect to see some degree of decline in revenue growth for companies with predominant exposure to the Namibian economy. For more on company expectations when it comes to earnings coming through from Namibia as of around the 1st of August, we're expecting some earnings to filter through. Romain Mostert, Head of Research at IJG Securities, here to give some earnings outlook and forecast there. Romain, thanks for joining us. So we have seen some concerning signs around a slowdown in the domestic side of the Namibian economy. How do you see that reflected in the bank earnings first and foremost?
Okay, so I think we would mostly see the effect of the slowdown on the Namibian companies with predominantly exposure to the broader economy, like your banks, for example, and also Namibia breweries or so. But this slowdown is mostly technical in my perspective, as we are facing a longer term uptrend with some strong growth expected in the medium term.
Mm-hmm. I mean, we've had Bank Windhoek recently list, so that certainly has been a development for the market to get exposure to that bank once again. And Bank Windhoek, FNB, both accounting for around 60% of private sector credit extension figures. So they'll give us a good idea in terms of the quality of loans out there, what we're seeing when it comes to NPLs. What are your expectations around that?
Okay, so far in the first half of 2013, we actually saw a bit more than 2 billion in net debt being issued to the private sector in Namibia. That is relatively slower when you compare it to end of 2013 when there was almost 4 billion, and I think 3 billion or slightly more than 3 billion in the beginning of the first half of 2012. So it is pointing to a relative slowdown, as you've mentioned previously, but we are not too concerned, expecting this to tick up towards the end of the year and finish the year off strongly. With that said, we would look forward to the non-performing loans impairment ratios. As we all know, it's at fairly low levels currently, pointing to very high qualities in terms of loan books, and we would look for any signs that shows that this is sort of a mean reversion coming through, or maybe a deterioration in the book. Otherwise, we will also be focusing on your market share levels, looking at FNB, Bank Windhoek, who is the two dominant players in the industry, on what to expect from them.
Interesting. Last time I spoke to you, you were talking about the fact that, relatively speaking, Bank Windhoek listing on the stock market, looking slightly more like a value play there relative to FNB. And the stock has since rallied, sitting at a P of 9.4, FNB sitting at 8.4. Does that change your view then?
Yeah, for now, in our recent quarterly strategy, we put Bank Windhoek on a hold, with FNB remaining on a buy, and that's just because of relative attractiveness of the stock. As you've mentioned, PE-wise, FNB is more attractive, and I think on a dividend yield basis, FNB is also trading at around 4.6%. 2013 dividend yield of dividends, compared to Bank Windhoek, that is lower at about 3 point something. So definitely some more attractive value, relative attractiveness in FNB.
Let's talk about Bidvest, 51% held by Bidvest South Africa. Mainly driven that drop in the first half earnings, interim earnings there by the fishing division, where we saw that less profitable drop there in horse mackerel quota, more competition. Are you concerned about the fact that their biggest earnings driver ultimately is under pressure, and that perhaps the diversification effect is not really offsetting what's taking place in the fishing division?
Yes, no, we are definitely a bit concerned when you look at Bidvest. Keeping the week's first half results in mind, we expect a bit of a rebound in the second half, as the company have access to more TACs in the second half. But however, higher costs will also start to have an effect. So a slight rebound from the first half into the second half, but still lower off in FY13 compared to FY12. What is, however, of a concern to us is the company's ability to maintain dividends at the previous levels. We already saw a bit of uptick in the dividend payout ratio, and we would expect that to continue into the future. And we don't know how sustainable is that dividends that they are currently paying. So maybe forward-looking, you are actually sitting on quite a low yield, and maybe a justification for the stock to derate.
So we'll watch out for H2 earnings, full year earnings ultimately. Namibian Breweries has moved into the soft drink space with the launch of Vigo. So portfolio expansion there, but I suppose ultimately still a brewery. Your thoughts on what we can expect from the earnings coming through?
So contrary to the trend that we've mentioned before, that we saw a bit of a slowdown in overall domestic demand, I suspect that we would see Namibian Breweries earnings be relatively strong for the first half of 2013 or calendar year 2013, mostly because we had such a hot, dry summer, and we would expect the consumers to be more thirsty compared to the average in the past. So we expect the brands to continue to perform strong, and some fundamental drivers to come through there. With that said, we are a bit disappointed on the JV losses that have been reported in the past. We would keep an eye out on what's coming through within this result season, and anything more than 100 million will be raising red flags in our in our opinion.
And that JV with Diageo and Heineken. Lastly, Oryx Properties. This has been one of the favorites for Namibian stockbrokers there. They've been building as well as buying properties. So how much have they been spending in terms of financing costs? Is their balance sheet strong right now to support those activities in the construction space?
Yeah, interesting that you mentioned that. Oryx have been, as you've mentioned, expanding at Marua Mall. They've been acquiring into the Gustav Hoek Centre from acquiring that from Growth Point Properties, and as a result, the debt has been ticking up, and I expected to see the financing costs and the split focus to weigh on the income statement in the short run. However, in the longer term, I suspect that you will definitely see the strong growth power coming through with valuation still remaining attractive. And maybe towards the end of the year, we could see management announcing a rights issue to maybe address the debt to equity levels. Although that will be diluting current shareholders, I think if you look at overall free cash flows, it will be a net benefit, as less debt will need to be serviced, and more free cash flows will be available for distribution.